Hello guys, welcome to today's to the last part of this video on demand and supply. I've already done the part one and the part two, and this is the third and the last part of the video on demand and supply. Right. So in the last video, I explained the psychology behind the formation of rally-based rally and drop-based drop. Right. So in this video, I'm going to be explaining the psychology behind rally based drop and drop based rally, right? That is this two formation, rally based drop and drop based rally, right? So I'm going to be explaining it in detail. Then when I'm done explaining, we are going to go to our MetaTrader app, where I'm going to be drawing different demand and supply zones so that we can see it practically, so we can understand how to do it practically. Now, for rally based drop and drop based rally, remember I told you that this um, demand and supply, or generally trading, is a war between the institutional traders, right, which is the banks, institutional traders, institutional traders, and retail traders, which is me, you and I, retail traders, which is you and I, right? I talked about it. Now, and the last video I told you about that fundamental traders, banks, hedge funds, investment banks, and big corporations that trade with billions of dollars, the battle is between you and them. It is either you are winning against them or they are winning against you. And for you to be able to win against them, you must be smart enough to know how to play their game by their rules and win, and to know what they're always doing at every point in time. If not, you keep losing money, because there's a big psychology behind movement of price. Things don't just happen like that. That's why demand and supply is very, very important, right? Now, rally based drop and drop based rally occurs as a result of bank traders or fundamental or institutional traders taking profit of existing trades or placing new trades. Remember, when you talk about rally, it means that they push the price up. When you talk about the base represents consolidation. So, or base represents where they are taking profits, right? So now for rally based rally and drop based drop, right? Now what it simply means is rally based drop and drop based rally means that it can these two zones, or this kind of pattern forms either when banks are taking profits, right? Either when they're taking profits, right? Taking profits, or when they're taking profits, or when they are opening new trades, right? So now this is the two main reasons that causes the formation of rally based rally and drop based drop. So now if we say they are taking profit, it just means that the bank traders cost a rally, then decided to um take take profits, and by taking profits, the market fell down, market dropped, right? Or it might just be that banks want to change the direction of the market. Let's say retail traders have been buying the market, and retail traders have been buying the market, and the institutional traders saw that there was a lot of liquidity, or there was a lot of money in the market, right? A lot of money in the market, because money of retail traders, and they decide that they want to take all this money. What do? Instead of buying again, they cannot decide that to make people lose money. What do? Or to make retail traders lose money, what do? They decide to sell. If they now decide to sell now, institutional traders, what does it mean? It means that every single person that is in this trade that was buying will be forced to come out of the market either in profit or in loss. That is, if I say profit, it means partial profit. That is partial profit for those that entered early and for those that locked in some of their profits. Let's say a retail guys that entered at this point now and we're riding the market up, right? Even if the fundamental guys are to change that, form a base here, right, and change the direction of the market down and sell, cause the market to sell. If they have been locking in their profit, let's say the guy that buys here, if he has locked his profits somewhere here, he might not make the exact amount of money he wants to make, right? But he will make some certain percentage of money, right? So at least from here to here is some pips, right? Now, the people that will lose money are people that entered late. That is to say, people that went to go and enter, let's say, around this point, or people that went to go and buy around the base. You understand? They will lose money because one major attribute of institutional traders is they will make it look as if the market was going to continue buying. They make it look like this base that is forming is just a retracement so that people will start placing in more buy orders, right? Then they will now, then once they do that, they will now um, make the price range up a little bit so that more people will begin to enter. Immediately they have gotten a lot of buy orders from retail traders, they will push price down. They will just force the price to go down and make a lot of these guys that bought late to lose money. You understand? And at this point again, once they consume all this, the pending orders here, price will just drop. You understand? So they will make a lot of money from people that bought late. You understand? So you understand the psychology behind this thing. So for the rally based drop and drop based rally, it is either the market, these patterns form either by um, institutional traders or bank traders taking profits of existing trades, which are of existing trades, or they want to enter a new trade. And them entering a new trade is they must have seen that retail traders have placed a lot of trades and they want to consume all their money or consume all the buy orders there so that they can benefit from the from from the market. So that's why you need good knowledge to know what is at play so that you don't become a victim of institutional traders, right? Now, I said that um okay let me go through this. It said the rally base drop or drop base rally zones which form due to bank traders taking profits has a lower probability of resulting in successful trades than zones that are created because of bank traders placing trades, right? Now, to understand why, we must look at the intention of the bank traders when they are placing trades. We must always know why the market is changing in this direction. We must always know why the institutional guys are coming into the trade, right? Now, if a bank is placing trades in order to make other traders lose money, the area at which they have placed their trades is important as they have a vested interest in keeping the market price from breaking that area. Now, in demand and supply, this means that when a rally based drop or drop based rally zone is created by bank traders placing trades, the bank must keep the market from moving past that point where they have entered their position in order to protect the trades they have placed. Now, let me explain what this means now. I said that, remember, I said that in rally based drop and drop based rally, these two zones uh, are formed as a result of either bank traders taking profits or bank traders opening new trades. Now, to explain this statement, statement here, let me use a diagram to explain. Now, let's say uh, the market was buying, right? The retail traders were buying, right? And the banks decide to change the direction of the market. They decide to change the direction of the market, right? And let's say they enter here. That is, they make the market range which is to create a new zone, right? And they begin to sell. What the statement means is, even if um, they, as they are causing the market to sell, sorry, let me use an example with um, sell. Let's say the market was selling, right? The retail guys were selling, retail traders were selling, right? And fundamental guys now decide to change the direction of the market by buying, right? Unless they start pumping, start buying, started buying. Now, what this that statement I just read means is that when they have caused the market, the direction of the market to reverse, they will do everything their possible best not to allow the market, even if it begins to range, no matter how much it will retrace, they will make sure it does not go past this zone, because this is where they entered. This is where they change the direction of the market. Changing the direction of the market means they enter the market at this zone. So what it means is that no matter what happens, even if the market is to retrace down, they will make sure it doesn't pass this zone, right? This zone. And another thing these guys do is that when they change, make the direction of the market to change, right, and the market begins to buy or sell. What in this example I'm using buy now. What these guys do is sometimes they can make allow the market to retrace. When it now gets back to this zone, some sellers now will think that the market will break this zone and continue going down further, not knowing that it's a trap by institutional traders. Now, once this thing now gets back to the zone that was created by the institutional traders or bank traders, they buy back again, or they add more buy orders at this point, which causes the market to pump again, causes the market to buy, and this time they will make sure it passes this high here, and they'll buy with massive intensity. Now, a lot of retail traders must have placed sell orders here, and by placing sell orders here, they will get activated, and as the institutional traders or bank traders buy, they will lose their money. You understand? So these are some of the things you really need to understand, to understand what these guys are doing. If not, you will not understand, and you just keep on losing money trading. You understand? So I'm going to explain further the other write-ups here, what it means, and how we can benefit from it. Okay. The main problem with drop is rally or rally based drop zones is determining if the zone that has been created by the bank traders is to make people lose money or of them taking profits. You understand? Now, for the structure of the rally based drop and drop based rally, to find out whether the zone you are looking at has been created due to profit taking, that is when the profit taking meaning um, institutional traders or bank traders taking profits, or from bank traders placing trades, that is placing trades, that is new trades, requires you to be able to understand the mechanics of where the supply or demand zone has been formed in relation to the current trend on the time frame you are observing, right? Now, the first piece of market structure in a rally based drop zone is rally, right? Rally base, which is the first buying power. And if it's for a drop, is drop is the sell, right? That first sell before the base, right? Yeah, before the base that forms. Now, analyzing analysis of the rally or drop is what will give us clues in figuring out what reasons the zone has been created, right? Um, Analysis of the rally or drop, right, is what will give us clues in figuring out what reason the zone has been created for. Now, the size of the candlestick which form the rally or drop, along with understanding where the wicks are on the candle themselves, can give us the majority of information needed to find out what the zones was created by. Now, when I was teaching candlestick analysis, I talked about different kinds of candles and their significance in the market. I talked about Moribozu, I talked about Haramis, I said that these two candles are candles that represents intense buying or selling pressure in the market. I also talked about rejection candles, that is candles that have very long wicks, either up or down, and I told you that they represent something, right? So now we are going to make use of some of the knowledge there and apply it here in this statement I just read, right? Now, so let me read this highlighted part again. Analysis of the rally or drop is what will give us clues in figuring out for what reason the zone has been created for. The size of the candlestick, which forms the rally, size of the candlestick, the kind of candle, how big the candle, right? Remember, big candles presents intense buying pressure. Anytime you see big candles keep forming, just know that institutional traders have entered, right? uh the size of the candlestick, which forms the rally or drop, along with understanding where the candle, where the wicks are on the candle themselves, can give us the majority of the information needed to find out what zone was created by, either a demand zone or a supply zone, right? So now, um, okay, this I'm going to be explaining this part with this diagram, this chart here. Now let's go through this explanation here. It said this up move occurred due to professional traders or bank traders taking, I don't know, let's start from here. So check out the rally which took place at the end of this down move, which is this rally here, right? At the end of this down move. Now, this move up occurred due to professional traders placing buy trades to make retail traders lose. Remember, it's a battle. Now, the way I can determine this is by looking at the previous moves up, marked with X in the down move. All of the previous up moves which took place before the rally have marked with the line did not move up in a strong way. This is the only move here that had this and this that moved up with very high buying pressure, right? The bullish candles they were constructed of were either small or hard wicks present on the top of the candles, which shows us that someone was selling, even though the market was moving higher. Each one of these up moves were created by bank traders taking profit off sell positions. Now, what I just explained here is this. If you look at all this now, the market was clearly selling from this point down, right? Now, from this statement, it means that all these candles you are seeing here with wicks represents that retail traders were selling, right? Retail traders were selling. Retail traders were buying, even though the market was clearly selling. Look at this. Market went down, then retrace. This all the buy here, all the buy is here with retracement. Generally, this is downtrend. Then it went down, right? Went up again, went down, went up again, went down like this. All the buy is here with retracement. Went down, went up, went down like this, right? So now the retail traders were clearly selling, right? We're clearly we're buying all these retracements happening here. But this trend was generally a sell, right? Now, from the last statement, let me read it again. From the last statement we just read, that all the previous up moves which took place before the rally have marked with the lines did not move up in a strong way, right? Look at them. Like I told you, all these up moves were all retracements, right? The bullish candles they were constructed of were either small or hard wicks present on top of the candle. Hard wicks present on top of the candle. Look at all these candles here. Have wicks, all of them. Wicks present, all of them, right? Hard wicks present on top of the candles, which shows us that someone was selling, even though the market was moving higher. Each one of these up moves was created by bank traders taking profits off sell positions. Now, if you look at the final up move, we can see the rally was much greater in size than the previous up moves, right? Which took place beforehand. This is mainly due to the size of the three bullish candles which made up the rally itself. Now, look at this. If you observe all the candles that was marked with X here, they all had wicks, right? Now, look at this one that formed here. This candle that formed here. Look at this. None of them had big wicks. Look at these three. Look at these ones. Once you see a market structure like this, it just represents one thing: the bulls. It just represents that the institutional traders or bank traders have come inside the market, right? Okay. It says all of the previous up moves which took place before the rally have marked with the lines did not move up in a strong way, which is this rallies here, right? They don't move up in a strong way. The bullish candles they were constructed of were either small or had wicks present on the top of the candles, which shows us someone was selling even though the market was moving higher, right? Now, each one of these up moves were created by bank traders taking profits off sell positions. I've already said this before. I'm just going through it. Now, if we look at the final up move, we can see that the rally was much greater in size than the previous up moves which took place beforehand, which is this up moves. I've already said this, right? Bigger in size than the previous up moves. These are the previous up moves, right? And the previous up moves which took place beforehand. This is mainly due to the size of the three bullish candles which made up the rally itself. These candles were far greater in size than the bull candles which the other up moves were constructed of, right? This means that the retail traders who were selling before the rally occurred had their trades turn from being at a small profit to being at a loss much quicker than the traders who would have been selling on the down moves seen before the other up moves, which I had marked with an X in the image. This is just it. Look at this. Look at this. You know, some people must have started selling at this point here. At this point here, right? At this point here. And this is the point where the retail traders started pushing the market up. Now, if you observe something, you will see that the institutional traders pushed price up. Let's mark out this is the zone they came in. Remember, I told you if they buy at a zone, they will make sure the price does not come below that zone. If not, they will lose money. So now look at what they did. They bought now, right? They bought. Then the market retraced. And look at what happened. They made sure it didn't come past their zone. Then when they noticed that people started entering, that is retail traders, started placing sell orders, they entered another buy, this time a bigger buy. And I told you, the next buy they will enter will pass the previous high. Look at this. They bought again and the market went massively up, consuming all the sell orders the retail traders must have placed, right? So with so many traders liquidating losing trades, the banks made a huge or a large profit even from the markets only moving a small distance. Since the banks have already made a profit from making the retail traders lose, they might as well make even more profit by placing more buy trades. There's no point in them making a small profit when they can push the market higher and make an even bigger profit, which is this. This is where they bought first. It went down and they bought higher here for this to this point, right? So that's just the explanation for this thing. So you need to understand what is at play, right? That's why you need to analyze your chart very well and understand what this retail guy, sorry, what the institutional traders or bank traders are doing, so that you can know how you can position yourself so you won't lose money. Okay. In this diagram, you will see that here's an example of a drop based rally which didn't work out successfully. Now, why didn't this work out successfully? Let me read this text here so you can understand. Now, why it didn't work out was because both the base and the rally were created by profits taken, right, from the professional traders who sold at the top of the move lower, right? Why the drop was big in terms of overall peak movement. It was not a movement which went on for a long time, like we saw in the other examples, which meant there would not have been a large percentage of retail traders placing short trades. Now, no matter how big the rally is in a drop based rally zone, or the down move in a rally based drop zone, if the market has not been trending in the same direction for a long enough time, it's unlikely for the zone to result in you having a successful trade. Now, what this thing means is the trend. Remember, I will always say that the trend is your friend. Any pattern, any structure, any zone you want to trade, it must be in the direction of the trend first, right? Always remember that. Now, look at this. This market is clearly a selling market. Now, from this text we just read, it says that if the trend has not been taking place for a long time, right? Even if you see this, this is the drop, right? The drop, and you see the drop base. This is the base, and a rally happens. If the trend has not been taking place for a long time, there's high chance that it will not result in a successful trade, right? If you look at this now, this one didn't rally as much as we wanted. Look at it; it didn't rally very much, right? It didn't rally that high. It didn't rally that high. So no matter how big the rally is in a drop based rally zone, or the down move is in a rally based drop zone, if the market has not been trending in the same direction for a long enough time, it's unlikely for the zone to result in you having a successful trade, which is what I just explained now. Remember, it must anything that's happening, any pattern, it must be in the direction of the trend, right? Now, the banks will only cause a reversal when there are enough retail traders for them to make a lot of money off. You understand? Now, the appearance of a supply or demand zone when the market has only been moving in the same direction for a short period of time or short length of time means there will not be many retail traders entering trades. Therefore, the banks will not be able to make a lot of money if they cause the market to reverse, as only a small amount of traders will be liquidating their losing trades. Now, what this statement means is, right? If look at this market now, it was clearly selling, right? And there was a base. What it means is, even if there are no enough retail traders placing buy orders here, right? If there are not enough retail traders placing buy orders here, there is no need for the banks to cause a reversal, because remember their target is retail traders. So if there are not enough retail traders here at this base here, they won't cause a reversal because they won't make a lot of money. But if there were a lot of retail traders here, plenty retail traders here, they will cause a reversal, because once the market is to reverse, they will eat a lot of money from retail traders. Now, another thing why there are no plenty retail traders is this is the reason. Is this: if this market now was not trending for a long time, you understand, it just came down for this short amount of pips, then it formed the base and it rallied up small, right, before it went down. Now, the best place for them to change the direction of the market would be somewhere around here, because it has been trending down for a long time. You understand? This is the best time for institutional traders to change the direction of the market, because it has gone down for a long period of time. It has been trending downwards for a long period of time. So even if they are to change the direction now, because change the direction here, they will make a lot of money, because when they make the market move up, or when then they take profits, it begins to buy back up, right? It begins to buy back up. Then sometimes they'll push it down again. When they push it down, they eat the money of people that went to go and buy. Then when they push it down, some guys again will enter sell orders, thinking market wants to go down up. Then they will now begin to enter massive buy positions and buy again, and take a lot of money from retail traders. So you see, the whole concept is they are after your money. Let me explain this. Look at this other trend here. Look at this. This one, it went down for a long period of time. You understand? If they have tried to reverse this market at this point, they wouldn't have made money because the trend has not gone down for a long period of time. But look at it. They waited for the market to go down for a long period of time, right? Then before they now started their manipulation, right, and bought and make their first profits by forming this zone here. And remember, it must not go below their zone if they are opening new trades. And as some people start selling, they bought again massively and earned a lot of money on people that sold, or people that sold leads. So you understand the concept and the psychology behind what these guys are doing and why you need to be very, very smart. You understand? Okay. I think this is our last example um on this material I'm using to explain before we go into practical examples in our MetaTrader app. Now, look at this. This is a drop-based rally, right? It dropped, formed our demand zone, and rallied, right? And rallied. Let me explain this now. Here's another drop-based rally, which I just explained now. Now, there are two things which made this drop-based rally a decent trade. The first was the rally out of the zone, which is that demand zone. The rally out of the zone, this rally out of this demand zone that was created here, right? The rally out of the zone, the rally out of the first. I'm coming. Please hold on. There are two things which made this drop-based rally a decent trade. The first was the rally out of the zone. The candles which made up the rally were bullish large candles, bullish large red candles, which pushed the market a large distance against the previous move, against the previous down move. This is the previous down move here. It went higher than it, right? Previous down move. These bull candles contain very little selling, meaning it's unlikely the banks were placing sell trades as the market rallied higher. Look at this. If you check these candles that rallied up here, you notice that they were completely bullish here, meaning that there was high buying pressure. Remember, in the previous example, I said that one of the ways to know if there are sellers is long weeks up, long weeks up, right? That is when you notice candles like this, long weeks up, long weeks up. That is bullish rejections, right? Now, but if you notice these candles here, you hardly see anything like that. They're big massive bullish candles, right? Yeah. So now the second thing was the fact that the rally managed to break the most recent swing high. This is this one. That's this one here with this arrow here. The most recent swing high. If you plan to trade rally-based drop or drop-based rally zones, the best piece of advice I can give you is to make sure the zone you are trading breaks a recent swing high for a drop-based rally. Remember, this is a recent swing high. He broke it. It went down. This is drop. Formed our base. He broke this swing high. Right? Make sure the zone you are trading breaks a recent swing high for a drop based rally zone, or a recent swing low for a rally based drop zone. Now, if the rally in a drop based rally zone manages to penetrate an old swing high, there is a much higher chance the zone will result in you having a successful trade than if no swing high was broken. The same thing goes true for rally-based drop zones. If the drop pushes the market below a recently formed swing low, there is a high probability of the market working out profitably, right? What the statement is saying, it must break a previous or go above a previous swing high or a previous swing low, depending on if it's rally based, whether it's rally based drop or drop based rally. Just take note of the fact that it must break a previous swing low or a previous swing high, right? The reason why a break of a swing low or swing high gives the reason why a break of a swing low or high gives the zone a better chance of working out is partly down to the retail traders who enter into long or short trades on the candle which breaks the swing high or low. When the market breaches a high or low, retail traders using technical analysis will know a possible trend change is taking place, as the majority of traders primarily use higher highs and lower lows to determine current trend positions. In the image, you can see the market was falling down until the rally broke the previous swing high. The previous swing high, that is this. Look at this example. This market was clearly falling down, right? It went down, it retraced back, then it went down again, right, and formed this zone. Now look at this. This is our drop. Now this our base. Now this rally broke the recent, the previous swing high, right? That's what that statement I just said now represents. In the image, you can see that the market was falling until the rally broke the previous swing high. Retail traders would have seen this and thought the market is changing from a down move to an up move. Therefore, after the market has hit the demand zone and is proceeding to move higher, before the swing high is broken, large number of retail traders are placing long trades expecting the swing high to be broken, which adds more buy orders into the market and thus increases the chances of a swing high and increases the chance the swing high will actually be broken. Another factor to consider is the retail traders who get trapped in losing trades when the market makes a new swing high or low. Like in this case, when this demand zone has been created here, right? Remember, some people will still go to go and place sell orders, right? Place sell orders, and then placing sell orders means there's enough money for the institutional traders to make, and they will now do what? Push the market up and make the market buy. And remember, they will not buy it when the market begins to retrace. They make sure it does not retrace below the point they bought so that they don't lose money. When it gets when retail traders start selling, as you can see here, start selling, right? And it gets close to the demand or around the demand zone, they buy again, this time with a higher buying pressure, which you can see here, with a higher buying pressure, so that they can eat all the sell orders of retail traders. So you need to understand how the game is played so that you don't lose money, right? Like I said, another factor to consider is the retail traders who get trapped in losing trades when the market makes a new swing high or swing low, right? So you just need to understand. Okay. Another thing to notice, when the market is in close proximity to a swing high or low, breakout traders will place pending orders at the high or low, expecting a breakout to occur. The movement which penetrates the high or low executes their pending orders, and they are entered into their trade. Let me explain this with this diagram here. Now look at this. Look at this high. This high, many traders are observing it, right? So now some people are expecting that this once the market start buying now, they're waiting for the market to come and break and pass this previous high. This previous high, right? Now, what the statement I just read means is that they will place their pending orders around this region. Their pending orders around this region of breakout, pending orders around the region of the breakout, so that when the market breaks out, because their expectation is when it breaks out from this line for the swing high, the market will buy higher, not knowing that they are falling into the trap of institutional traders. Now once institutional traders notice that plenty people or plenty retail traders have entered around this swing high, right? Around this swing high or their pending orders have been activated around this swing high, you will notice that they will push the market a little bit up. It will buy for some time. And if buy for some time means that they want more retail traders to buy further. Now, the moment these retail traders now buy further, what do these guys do? They enter and begin to sell. And begin to sell. Now, them selling means that all the people that bought at this top, they will have to come up with the trade with loss because they will push the market down. Now, one thing these guys will do is they have eaten the money of people that bought high at this point. People that bought high. Now they will now make the market begin to reverse. Remember, it will never get past their zone. It will never get past their zone. That is why you should always wait for a zone, the zone you are very sure of. That is your point of entry. That zone is where you enter. Now, sellers have entered here as it is retracing down. Now, once it gets close to their zone, they will now buy with a higher buying pressure now. Now, buying again means they have eaten money of people that bought high, and they have eaten the money of people that bought late. Because some people wait, let it break this this low. As I broken this line here, it begins to go down. People will now begin to enter sales. As it gets close to their demand zone, they buy again. This time, massive buying pressure, meaning they have taken the money of retail traders that bought when the swing high was broken, and are taking the money of retail traders that bought when it started retracing down to this point. You understand? Retracing down to this point. So you see that they made money from both buyers and sellers that didn't understand what was at play. Always remember, your point of interest for your entry is the zone. You understand? Because no matter what, they will make sure that they don't push price above that zone. And how do you identify the zone of institutional traders? Is the intense buying pressure. Look at it. This was a drop. Then the base. Look at all the candles that formed here. Big bullish candles. Meaning that institutional guys are here. Then they push price down. And from this diagram, there's something I noticed. Look at this. If you understand candlestick analysis very well, you understand that this pattern here is an inside bar pattern indicating that the sellers are in, right? So if you're a scalper can easily enter. If you have been buying and you notice this pattern, you can easily just close your buying orders, because this thing represents that the market is going to go down for some time, right? Then you can easily enter your sell and keep observing, watching the candles that are forming. Right? The moment you begin to see big bullish candles like this candle here, it's an indication that these guys will soon buy again. So if you have been selling, this is a very good reason why you should run out. Or even if you don't run out, it will pull you out if you have locked in your profit. Or even if you don't lock in your profit, the moment you see this big candle, you run, right? So that's why you see that it's very, very important to understand candlestick analysis. All these topics I have been teaching from part 1 down to this stage are very important, because you are going to be combining all of them. No one is less important. They are all very important, because you need very good solid knowledge in understanding what is at play, because forex trading is way bigger than what many people think. It's a game of psychology. It's a game where you are fighting against people that have been in the game, that understand the game, understand the system. So you must know how to play their game, right? Now let me just read this last part. Now, as price fails to continue moving in the direction of the break and begins falling in the opposite direction, the breakout traders will become trapped in their now unprofitable trades, which I just explained, right? The point where these traders will end up closing their trades is oftentimes right at the point where they move, which broke the high or low originated from. What this statement means is they will close around this point. Once they see that the market has gone below this, they begin to close their positions, because they will wait and see if and see if this down move is just a mere retracement that will bounce off this swing high and go up. But the moment it breaks it and goes a little bit lower or goes lower, they know that the market is going below that point, right? So that's just what that statement means now. All right. Okay. As the price fails to continue moving in the direction of the break and begins to fall in the other direction, the breakout traders will become trapped in their own unprofitable trades, right? The point where these traders will end up closing their losing trades is oftentimes right at the point where the move which broke the high or low originated from. That's the demand or supply zone. I've already explained that. When the breakout traders closing their losing trades, a large number of buy sell orders will come into the market, which the bank traders will use to get more trades placed in the direction of the reversal. So this is the end of the explanation for the GST. Or let us see the all the explanation or the psychology behind demand and supply, right? So I'm going to use some minutes to explain or to give us practical examples of charts, right, and how to draw demand and supply zones so that we can understand it practically. Okay. In this example, let's try and look for demand, or let's try and draw demand and supply zones in USD card first. That's United States dollars against the Canadian yen, right? So let me invert my phone. Right. Okay. We have, remember, we have rally base rally, drop base drop, rally base drop, drop base rally, right? These four. So let's try and identify and see. Let's go to previous ones and see, right? Now I've already seen one. Look at this. This is what? Rally, our base, right? And drop, right? This is also a base from that one. Now if you are to draw this thing, okay, let's use our triangle tool practically. So you just touch your MetaTrader app, click on this tool, click on this, right? So now remember, you are going to mark out the area where the base was formed. Remember, it's not like support or resistance. It's a zone, right? It's a area, a region of price. So this is our zone, right? Then we are going to mark out. Let's do that for this because this place here is, this point here is a base too. It's also a base, right? Now if you draw this, look at this. Just look at how powerful this thing is. Look at this. Look at this. If you notice this zone, look at if we start drawing it from the date here is 25th. 25th. Look at this. Look at where this base is formed first, right? The date here is 25th, 22nd, sorry, 12th of December 2022. That was where this first base formed, right? This first base formed, right? Now, if you have drawn this base, now look at this. Let's assume we drew this base and marked it out and left it. Look, the market, this was rally base, right? Drop, right? Remember, I said that anytime we draw a base, we should mark it and leave it, because the market will always come back to that zone and it will react in a certain way and go back. Look at this. It went down, did all it was doing. We are just waiting for it to reach our zone, right? Waiting for it to reach our particular point of interest. Look at it. It bought. The moment it reached this zone, this is supply. Remember, our supply zone. what happened? It sold again. Remember, I said that price is repetitive. What has happened before will happen again. Look at it. It went down, right? So just see how easy it is. Now, if we are to draw um this previous zone here, if you are to draw it further down, you notice that it's also a zone. So with demand and supply, you know exactly what to do. Look at it, right? It rallied, formed this zone. We marked it out. After marking it out, it came down, formed this zone here, right? It rallied here, came down, formed this zone here first, right? It now went up and did like it wanted to buy and came down up again, came down. And remember, it did not go down because this is the handwork of institutional traders. Look at the candles that formed next. And it bought again. Look at the candles that formed here. These three big candles. What does this show you? It's telling you that this is the handwork of institutional guys. Institutional traders entered this trade. Right? So you look. Just be following me and you understand. It went up here, came down, formed this zone, came down. It didn't still break it. Then institutional guys bought it up again. Then it did what it was doing, came close to the zone, range small. It went back to this zone up here, right? Then it came down, back to our zone again, our demand zone, right? This our zone is demand, our demand zone, right? And went back up again, back to that previous demand zone. So you can see that it has touched this zone. Let's count. From this point, this is 1, this is 2, this is 3, this is 4. You understand? So remember, your pending order can be anywhere around the zone. Then your stop loss should be above the zone. Always remember that. If I'm looking for selling opportunities, my stop loss should be above the zone. If I'm looking for buying opportunities, my stop loss should be below the zone, right? So now you see, look, after I came back to this our zone here, right? It came down and went down with massive pressure. What does this thing teach you? It's telling you that these massive candles you are seeing, one of the main characteristics of institutional traders is big, massive candles. Once you can sight the presence of big, massive candles, just know that they are inside. Fundamental guys or bank traders are inside. Now, let's assume we are in this point now here, right? We are in this point now, and we sold to this point. Our TP will be here. Just remember, the next zone is our TP, and when it came here, we bought to this point. And let's say I had a pending order, because most of the time, one thing about demand and supply is if you are always waiting for candlestick patterns, sometimes you miss out in some big moves. Because one of the things that these fundamental guys do is they don't give you signal sometimes that there's going to be a massive move. They just go straight so that you miss it. Like, look at this now. This particular candle that formed here. Look at it. There was no candlestick pattern. It just went down massively and came down and broke this zone. Now, what will you do? You can zoom out. There's something we call top-down analysis. Top-down analysis means you do analysis on higher time frame. Let's say maybe D1, H4 on 1 week. Then you begin to from there you begin to do analysis on smaller time frames, so that you will know what is happening from the small time frame down to the big time frame. Yes, so you can know where you can make your entries. Remember, the bigger time frames are where you make your major analysis. Then smaller time frames are for entries. You understand? So now that it has broken this point, we have to zoom out and look for a time frame or look for a point in time where price was around this region. Now, if you look at this time, and where's our crosshair cursor? This. Okay, if you look at this now, the previous time price came around this region was in 2022. That is June, right? June 12th, 2022. That's around this region, right? That's the last time price came that low, right? So now we can, what do you do? Okay, this is a zone. Remember, like I told you, what had happened before will happen again. This thing I'm drawing here is a base, right? Which means it's a zone. So we draw it. We draw it. We draw it. Let me switch to 4 hours so that I can have a better chart, right? We draw it. Now, if you now zoom in now, right, you now check. Since price has reached this point, if you check now, there's no previous zone there. So you keep checking. The closest zone where you suspect that price will drop down to is this zone here. This zone is just drawing from here. So now your analysis will now be that price will drop down to this base before it goes up again. So if you must make any entry, you must wait for price to reach this demand zone before you make your entry, because price will react fast in zones. The same way you are looking for demand and supply zone is the same way that these bank traders, they don't just trade anyhow. They wait for price to reach specific zones, previous zones they must have created in the past before they react. You understand? So this is just an example with a USD card, right? So I believe you understand. Maybe you just do practice with other currency pairs to understand it. This is most of the time, if you check the charts of most professional traders, you see things like these rectangles. If you just want to make it what some traders do is they usually fill it, that is to shade it with color. What you just do is you just click on it, touch it like this, then you can, if possible, you want to make it black, and this is black, right? Then fill means to make it look like it's shaded. You click on fill, click on done. When you now turn it, look at how it looks now, right? This is just exactly how most professional traders do their own. You now repeat the same thing for the one up. You edit it and you fill it. That's just it. You understand? So if you look at it now, we have two zones. We are looking at, right? Our demand and supply zone. And remember, once you are marked out your zone, let's say I marked out my zone in this point and this point, you see that trading becomes very easy for me, right? Once I have this, I've already marked out my demand and supply zone. Once you have a rally base, once you can mark out the base, remember the base are usually those highs, rally base, drop base, rally, mark it out, rally base, rally, mark it out, drop base, drop, you mark it out, like that. So if you can see from this example here, if we have drawn this our rally here, this is our base here, and here, and we have extended the triangles this far, you see that trading becomes very easy for us. All I just need to do is just come and look at my chart. When price gets to our demand zone, if I want, I can place my pending orders, buy. As it begins to go up, I begin to lock in my profit. The fact that I is buying does not mean that it must reach the supply zone, right? So I begins to buy, I lock in my profit, right? Lock in my profit. Then even if it goes down, I'm still in profit. Then the only point I will buy again is if it comes or touches my demand zone. If it doesn't touch your demand zone, don't buy, right? You wait and look at it went to supply zone, which means it's giving us the selling opportunity. And if I have already placed my pending orders, it will sell down to this demand zone, right? Now I reach my demand zone again, I buy. Reach my demand, my supply zone, I sell. So you see how easy it is. It makes trading very easy. Demand and supply makes your trading experience very easy. I know this video is very lengthy and very long, but it's very important to understand this concept. It makes trading very easy for you. Don't forget to like this video, if possible drop a positive comment about the video, and subscribe to the channel. And if you have a friend that wants to learn how to trade, everything, this is the last topic I am teaching on Forex. I've taught every single thing that there is to teach, that I know of. I know there are still a lot of things I don't know about, but the ones I know, I've taught it for free on the channel, right? So if you know anyone that wants to learn how to trade for free, just give them the link to the channel so that they can also benefit. The next thing I'm going to be talking about is synthetic indices. Then after synthetic indices, I will talk about my Forex fund, how to get a prop account, and how to pass the stage 1 and stage 2, so I can get a real, so I can use just $50 to get a funded account, trading account with $5,000. Thank you for your time.